Before I do, one important note. I've written this as an engaging voiceover script per your specs, but I want to flag that several claims in the source, specific short squeeze, coiled spring framing, virtually guaranteed bull case, curiosity-driven questions implying explosive moves, lean toward hype. I've kept the energy and your requested style while softening the most overstated guarantees slightly and strengthening the financial disclaimer, since presenting speculative outcomes as near certain could mislead viewers. Here's the result. Mini hash voiceover script. What if I told you that a 30% short position just turned one of the market's most hated stocks into a tightly coiled spring, and that everyone panicking right now might be making the exact wrong move at the exact wrong time? Welcome back to Calvin Mateo, the channel where we cut through the headline noise and follow the numbers. Today we're breaking down whether HIMS and HERS stock is about to explode and why that enormous 30% short interest could change absolutely everything. If you find this breakdown valuable, do me a quick favor and hit that like button and subscribe. It genuinely helps the channel grow and it takes you 2 seconds. Now let's get into it. On Monday, August 10th, HIMS and HERS reported its second quarter earnings and the stock immediately fell in the pre-market. At first glance, the market is telling you that the growth story is dead, that the bears were right, and that the stock is a value trap. But if you look at the actual data, you start to see something the headlines completely missed, one of the most asymmetric setups of the year. Today we're going to break down the Q2 earnings statement, deconstruct a temporary $80 million cost event, and look at a 30% short interest position that has effectively turned this stock into a tightly coiled spring. By the end of this video, you'll have a clear analytical roadmap showing why the consensus view might be wrong and how to think about this setup, whether you're a short-term trader or a long-term compound investor. So to understand why this gap down could be a major mispricing, we have to look at the massive divergence between HIMS's operational growth and the headline contagion that panicked retail investors. If you only read the headlines, you saw that HIMS and HERS reported a staggering $86,300,000 GAAP net loss. But while the headlines screamed about this loss, they completely ignored the operational hypergrowth happening in the core business. Revenue surged over 38% year over year to $753 million. Their subscriber base expanded 19% to nearly 2.9 million active subscribers. And their adjusted EBITDA came in at over $60 million, beating Wall Street consensus by 27%. So think about this for a second. We have a business whose operational engine is firing on all cylinders, yet the stock is gapping down because of a single bottom line headline. Could this really be a case of headline contagion hiding a highly functional, highly profitable business model? But before we deconstruct that net loss, we need to understand the technical context of how we even got here and map out the extreme daily volatility we're trading in. The last 2 weeks of trading have been a wild roller coaster. On July 29th, the US Federal Trade Commission filed a lawsuit against the company, causing a brutal 14.7% crash that sent the stock straight down to $25 on massive volume. But look at how resilient the stock was. Within days, it staged a 10.9% recovery to close at $31.77 on August 10th. Now, after earnings, the stock has reset back to the $29 level. With an average true range of 2.94 and a massive beta of 2.40, this stock is extremely sensitive to news. The pre-market gap down has broken the short-term moving averages, but it's setting up a critical retest of structural support levels. And here's the question worth sitting with. When a stock this volatile compresses this tightly, what happens when the pressure finally releases? That volatility can feel intimidating until you look at the actual earnings scorecard side by side with Wall Street's expectations. If we put the Q2 earnings matrix right next to consensus, we find a massive variance. Wall Street expected a narrow net loss of 11,500,000 and HIMS reported 86 million. That's a 32-cent EPS miss. But look at the operational line items. Revenue beat expectations by over 7%, subscribers beat by 1.4%, and monthly revenue per subscriber surged 21% year over year to $92. This shows us that the top-line growth isn't just intact, it's actually accelerating. So here's the puzzle that breaks the bear thesis wide open. How does a company beat on every single top-line metric, beat on adjusted EBITDA, and still post a massive 32-cent EPS miss on the bottom line? Here's where the story gets more complicated and where we have to deconstruct what I call the cost avalanche. That $86,300,000 headline loss is not from operating inefficiency. It's a temporary cost avalanche of one-time charges. First, HIMS took a $47,500,000 legal reserve for the FTC data privacy lawsuit. This brings their total reserves to $62,500,000, effectively capping their legal liability and removing a major cloud of uncertainty. Second, they paid $28,800,000 in one-time transaction and integration costs to close the Eucalyptus acquisition early. Finally, they had a tiny $4,600,000 restructuring charge to complete their transition away from compounded weight loss drugs. Now watch what happens when you strip away these three non-recurring adjustments. HIM's true operational baseline was a net loss of only $5,400,000. The operational business is essentially run rate profitable, and the headline loss is overwhelmingly accounting noise. But while that cost avalanche is temporary, there is one real structural risk that investors must watch closely. The biggest structural bear argument is sequential gross margin compression. Over the last 4 quarters, HIM's gross margins have declined, landing at 64% in Q2. This compression is driven by a product mix shift. HIMS is scaling lower margin branded weight loss drugs like Wegovy and Ozempic, alongside international revenue from Eucalyptus. CFO Yemi Okupe confirmed that gross margins will remain below historical levels as a deliberate trade-off for global scale. So if you're a long-term investor, you have to accept that HIMS is transitioning from an 80% gross margin cash business into a highly scaled, lower margin digital health network. And that raises the real question, can the sheer volume of subscribers grow fast enough to offset this margin decline? But before you get too bearish on those margins, let's look at the forward-looking catalysts that management is putting on the table to drive growth. Despite the margin headwinds, management is remarkably confident. They raised full-year revenue guidance to a midpoint of $3.2 billion, comfortably ahead of Wall Street estimates. More importantly, they guided Q3 revenue to $880 to $900 million, which represents a massive 18.2% sequential increase from Q2. And to protect shareholders, HIMS has a $225 million share buyback program. CFO Yemi Okupe openly warned short sellers that the company will aggressively buy back shares if the price disconnects from its intrinsic value. Think about what that means for a stock with a 30% short position. That buyback could act as a powerful floor underneath the entire setup. And that top-line acceleration doesn't even include a massive multi-billion-dollar regulatory catalyst that's quietly developing in the background. A major growth catalyst that Wall Street seems to be almost completely ignoring is the $2.2 billion peptide market. In late July, the FDA Compounding Advisory Panel recommended 6 out of 7 peptides under review, including sermorelin and ANED+, for compounding eligibility. This opens up a massive preventive health and longevity market. And because HIMS owns a vertically integrated peptide manufacturing facility in California, Leerink Partners estimates HIMS is uniquely positioned to capture 20% of this market, potentially unlocking an incremental $440 million in annual revenue. Here's what makes this so compelling. This is a potentially high-margin revenue engine that the market is currently pricing at roughly zero. What happens to the valuation the day the market finally wakes up to it? To capture that massive opportunity, HIMS is leaning on a proprietary clinical platform that's dramatically lowering their costs. Because HIMS isn't just a digital pharmacy, they're a sophisticated technology platform. By integrating an AI clinical engine into the new HERS app, they've tripled customer messaging engagement while cutting down on human labor costs. That AI clinical engine successfully resolves 80% of non-clinical questions and reduces human support task loads by 50%. Management expects this AI technology to pay back within 12 to 18 months, structurally lowering customer acquisition costs and driving long-term margin efficiency. This is the kind of technological moat that means as they scale globally, their operating leverage actually increases instead of collapsing. When you look at this combination of growth and technology, you have to ask a simple question. Who is actually buying these shares while everyone else runs for the exits? Because while retail investors are panicking, the smart money appears to be aggressively buying the dip. Institution ownership stands at 63.5%. BlackRock holds an enormous 11.9% stake with over 26 million shares. Vanguard holds a 5.01% position, and pension funds like Kalstrez are raising their holdings by 22%. But the single most telling transaction comes from board member and former Netflix CFO David Wells, who executed a $1.17 million open market purchase of 48,000 shares at $24.23. When a world-class financial mind puts over $1 million of his own money on the line, what exactly does he see that the panicking crowd doesn't? With institutions and insiders locking up the float, the market microstructure starts to look like a tightly wound spring. And this brings us to the core technical setup. HIMS carries an eye-popping 30.07% short interest. That represents over 61 million shares sold short, with a days to cover ratio of 4.5 days. On the options chain, we have massive put walls stacked at the $27, $26, and $25 strikes. These put walls can act as a structural floor because options market makers may need to buy shares to hedge their positions as the stock approaches those levels. And on the upside, we have massive call walls at $31.50, $32, and $35 that could act as cascading targets if short covering ever begins. So picture it, 61 million shares short, a company promising to buy back stock, and insiders accumulating. What happens if all of that pressure releases at once? So how do we strategically approach this coiled spring? Let's look at our first tactical setup. For short-term traders, we have strategy blueprint A, the breakout squeeze. The thesis here is to capture rapid price expansion if that 30% short float is forced to cover. To manage risk, you do not chase the gap down. The trigger entry is a confirmed daily close above $32.41, which reclaims both the critical 200-day EMA and the daily pivot. You'd place a strict stop loss at $29.80 to protect against a failed breakout and target profit-taking levels at $35 and $40, right where those heavy call walls sit. But if you're a long-term investor who prefers the steady path of compounding value, your plan looks very different. For long-term investors, we have strategy blueprint B, the value accumulation play. The thesis here is simple. You're buying high-growth revenue at a headline-driven discount backed by a $225 million buyback floor. The target entry zone sits between $25 and $28, aligning with weekly support and the FTC lawsuit bottom. You place a structural stop loss at $23, which would represent an invalidation of the fair value thesis. And if the business executes its global consumer health trajectory, some analysts are modeling a multi-year price target of $100 or more by 2030. Whichever playbook you lean toward, you have to track the performance criteria to verify that the core thesis is actually holding up. Over the next 2 quarters, there are 3 key operational metrics worth monitoring. First, we want to see gross margin stabilization at 64% or higher to prove that the GLP-1 product mix shift has leveled out. Second, we want the FTC lawsuit settlement to remain fully contained within that $62,500,000 accrued liability reserve. And finally, watch for the final FDA PCAC decisions on peptides to confirm that $440 million market opportunity. If these 3 milestones are met, the long-term bull case gets dramatically stronger. And that brings us to our final verdict on HIMS and HERS Health. Before I give you my take, let me be crystal clear. I am not a financial advisor, and nothing in this video is financial advice. Everything you've heard today is for educational and informational purposes only. Stocks like HIMS are extremely volatile and carry real risk of significant loss. The price targets, strategies, and scenarios I've discussed are speculative and are absolutely not guarantees of future performance. Always do your own research and consult a licensed financial professional before making any investment decision. Only invest what you can genuinely afford to lose. With that said, here's the picture. HIMS and HERS Health looks like a classic generational transition phase. The top-line hyper-growth appears largely untarnished, and the bottom-line turbulence is heavily tied to finite, one-time corporate adjustments. With a $225 million buyback floor and significant short squeeze potential, the setup is genuinely compelling for those who understand the risks. If you choose to act, the 2 paths are clear. Consider accumulating in the $25 to $28 value zone, or wait for the confirmed breakout above $32.41. Stay analytical, tune out the headline noise, and let the numbers guide your decisions. Now I want to hear from you. If you had to choose right now, would you play the aggressive breakout squeeze above 32.41, or would you patiently accumulate down in the $25 to $28 value zone? Drop your answer in the comments below. I read every single one, and I'd love to know which camp you're in. If this breakdown helped you see past the headlines, smash that like button and subscribe to Calvan Mateo so you never miss the next deep dive. I'll see you in the next one.